Good afternoon, and thanks for joining us for our December webinar on the corn and soybean outlook. I'm Jim Mintert, Director of the Purdue Center for Commercial Agriculture. And joining me today in the webinar are Nathan Thompson, Assistant Professor in the Department of Ag Economics here at Purdue, and Michael Langemeyer, who's also a Professor in Ag Economics as well as the Associate Director of the Center for Commercial Agriculture. Before we start, I wanted to remind everybody that we have the Purdue Top Farmer Conference coming up on January 8th. This year's conference will be held in a virtual format, so the details are available at our website, purdue.edu/commercialag. And when you get there, if you try and register, you'll probably get a notice that says you're going to be put on a waiting list. We're in the process of expanding the capacity for the Top Farmer Conference, so don't worry about that. You can go ahead and register, and we'll take care of that in the background. So check it out. There's some details available on the website. So before we really start talking about the corn and soybean outlook, I wanted to spend just a little bit of time talking about some other information that USDA released recently, and that is their revised net farm income forecast for 2020. It's the third highest on record. They came in with a forecast of $120 billion. Virtually everybody was expecting them to raise the income forecast, but it was a little bit of a surprise with the magnitude of the increase that showed up on this report. And of course, the big boost to income really came from the direct government payments that were made to farmers, and 46.5, almost $47 billion of payments across the various programs. That includes the farm program payments as well as the seafarer payments. So that combination has really made a big impact on farm income here. And I think some folks have really questioned what that means for the income for 2021. We don't have an explicit forecast. The three of us discussed this earlier today, but we don't have an explicit forecast for what government payments might look like in 2021, but they're going to be substantially lower than what they were this year. Probably our best guess is, if you look at the chart, maybe 12 to perhaps 14 or $15 billion next year. So that's a pretty big drop in that government payment level. However, if you think about the magnitude of the increase what we saw in income, that still suggests farm income in 2021 will probably be higher than it was in 2019. So we're anticipating a decline in income in 2021 relative to 2020 because of that big drop in government payments that we're projecting, but still higher than it was in 2019. And Michael, you took a look at government payments relative to farm income and really went back pretty far into history to look at the impact of government payments going back into the 1970s. So take a look at that for us.
Yeah, this chart shows 1973 to 2020, and Jim's previous chart only showed 2012 to 2020. And if you go back to 1973, the 46 billion is really large, even over this long period of time. And so that's very, very important to point out. And notice here, 2020 really sticks out, if you will. Very high net farm income and close to 40% of net farm income coming from government payments. One of the questions we sometimes get is this unusually large to receive this much this much of net farm income from government payments? The short answer is yes, but you can see on this chart that there was several years where the percentage of net farm income coming from government payments was higher. 1987, 1999, 2000, 2001, and then 1983. 1983 was a very low net farm income year, and so most of the money, most of the net farm income was coming from government payments in 1983.
Yeah, so it's a very unusual situation, one we don't expect to see repeated in 2021. But I think one of the other points to remember, though, is the fact that although we're anticipating farm income declining in 2021 relative to 20, it's still likely to be higher than it was in 2019.
Yeah, the long run average is about 81, 82 billion adjusted for inflation. And so it looks like 2021 is going to be above that long run average.
Yeah, very much so. Let's turn our attention to the information that USDA released yesterday, and that was the updated crop production and world ag supply demand estimates. And in some respects, there wasn't a lot of new information on the WASDE report. No change in corn production, so no change in acreage or yield. So corn production is still projected to be that 14.5 billion bushels, same number we had last month. No change in the export forecast from USDA, still 50% higher than it was in 2019, so a large increase at 2.65 billion bushels. But I think some people in the trade, excuse me, some people in the trade were maybe anticipating a larger increase or a bigger increase in exports than what USDA is currently projecting. So we went back and took a look at exports from the weekly data that USDA's Foreign Ag Service releases and looked at exports to all destinations up through the first week of December for the last, really the last 5 marketing years as well as this year, so 6 years in total. And as you look at the data, you know, one of the things that kind of jumps out at you is exports up 61% this year in total compared to last year. And maybe the surprise is this increase in exports to China. So the exports to China really account for about 85% of the increase in exports that we're showing for the 2020 marketing year so far. You know, one of the wild cards in the outlook is going to be whether or not we continue to see some corn exports going to China. If you look at this chart, historically, China has not relied on the U.S. for corn imports. And so this 143 million bushels that I'm showing there for the first few weeks here, the first, I think, 14 weeks of the marketing year, very interesting. And so let's just take a look at maybe what's going on in China that might be causing this. A big driver behind this is China's desire to rebuild its pork industry. And maybe a way to look at that is to think about just how big China's pork industry is relative to the US. So I'm going to show you China's hog slaughter on an annual basis going back to 2009. And I've highlighted the data from 2018 going forward. And notice that in 2018, hog slaughter in China totaled almost 700 million head. That's an astronomical number, and one for those of us that are more accustomed to looking at the US pork industry find a little hard to get our arms around. And then notice, of course, China, well known, I think, for this audience, that China had a lot of trouble with African swine fever. And notice the impact that's had on their slaughter volume these last couple of years, dropping to 544 million head in 2019, 455 million head estimated by USDA in 2020. And then notice for 2021, USDA is anticipating a recovery in hog slaughter in China to the tune of about 50 million head. Again, think of that 50 million head and how large that is. And to maybe put that in perspective, I'll just put the US hog slaughter numbers on there on an annual basis, again, going back to 2009. And notice that the US in 2021 is projected to slaughter about 134 million head. So China is anticipating a 50 million head increase. You think about that in the context of what that means relative to the size of the US industry. That's a huge increase and really helps explain what's going on with respect to China's demand for corn and China's demand for soybeans. And I guess the related point is not only are they attempting to expand their hog industry, but they're really trying to commercialize it in the sense that they're adopting more of a modern production system, which is more heavily reliant on corn and soybean as the primary feedstuffs, as opposed to more of the backyard small farm model. So you've got two things going on, both of which make it really difficult to forecast with any degree of accuracy just what this means in terms of the needs in China for imported corn and imported soybeans. Clearly providing a big boost, but fine-tuning the forecast, pretty difficult. USDA didn't change their forecast with respect to the quantity of corn that's going to go into ethanol. Still 5.05 billion bushels. That's up a little bit compared to last year. The 2019 crop came in at 4.85 billion bushels. I guess the question mark for us is, will that really happen? And so to take a look at that, we took a look at ethanol margins. This is based on the Iowa State data where they simulate margins for an ethanol plant on a daily basis. And I've just plotted the data from the fall of 2019 forward. Notice how those ethanol margins had recovered pretty strongly in early fall, but the last few weeks they have really collapsed. And in fact, the data for the end of last week, the most recent data we had, actually turned negative again. So those ethanol margins collapsing, I think that's tied back to what's going on in the U.S. economy. And as you look at what that means in terms of ethanol production, these are the ethanol production numbers expressed as a percent change compared to the same week a year earlier. Notice in the beginning of 2020, ethanol production was actually running ahead of the prior year's pace. As the pandemic unfolded, and I've kind of highlighted that in late March is when we started to see ethanol production drop. And then we saw the recovery into the summer months, but notice in recent weeks, we're still running, depending on the week you pick, between 4 and 8% below a year ago. So USDA is forecasting an increase in quantity of corn going into ethanol. That's going to be a challenge. And clearly, I think their expectation is that we'll see ethanol production pick up in the last half of the marketing year. But that's going to be a while, and it remains to be seen how quickly we really do see that happen. What's your take on that, Michael and Nathan?
I think just like you said, I think we're going to struggle to get back to where we were in terms of the previous year. And so I would expect those negative bars to continue at least for the next 2-3 months.
Yeah, I kind of think that's the issue. I see ethanol production remaining below a year ago levels, maybe all the way through the winter. And perhaps as we get into spring, we might see a rebound. And I think that's what USDA is anticipating, but that's clearly a risk to the forecast. So you think about the numbers, maybe some positivity out there with respect to the export side, especially if we can see some continued increases going to China, maybe a little bit of negativity on the ethanol side. USDA did not change their projected ending stocks for the end of this crop year, still at 1.7 billion bushels. I thought it would be instructive, though, to just look at how dramatically this has changed as we've progressed through the summer of 2020 and here now into late fall, early winter. Back in June, USDA was anticipating or forecasting that we would see a carryover from the 2020 marketing year into 2021 of 3.3 billion bushels. And notice how that was coming down as we went through the marketing year, as we went through the summer and into the early fall. With the current projection for carryover running a little over half what the forecast was back in June. So, and I put that up not to poke holes or poke fun at the World Board in terms of their forecasting. That just illustrates how dramatically the world has changed over that short span of time. It's been a very volatile year in terms of what's taken place with respect to both supplies and usage, but especially on the supply side.
And the forecasted price, Jim, has followed a similar trend. I think it was close to $3 in June, for the current marketing year, and of course now we're up to closer to $4.
Yeah, so I think really the question mark is if you look at the ending stocks estimates, USDA really didn't change that appreciably on this last go around because the ending stocks didn't change. If you look at it relative to usage, still averaging about 11%. Which is a relatively tight supply. But if you look at it historically, the years when we've seen some real volatility in corn prices, we've tended to drop that ending stocks as a percentage of usage below 10%. And that's a possibility this year, right? Especially if we see some carryover with respect to this growth in exports we've seen in the early part of the marketing year. So keep your eye on that. We're going to talk a little bit more about that in just a minute. But that 11%, could easily drop below 10%, and that's when things start to get a little bit more interesting. So, Michael, you mentioned the marketing year average price forecast. USDA didn't change it this month relative to last month, but last month, of course, was a 40-cent bump, and that followed, I think, a 40-cent bump the month before that as well. So we've bumped that up twice this fall, but $4 still puts us the highest price we've seen since the marketing year average of 2013 when it averaged 446. And as you look back, and I'm going to back the slide up, as you look back at 2013, the carryover as a percentage of usage was 9% that year. If we see some further tightening with respect to those ending stocks, that starts to bring in some possibility of seeing that marketing year average climb above that $4 mark, don't you think?
Yeah, I think that's definitely the case.
Nathan, you have taken a look at some marketing alternatives and you like to look at storage opportunities and evaluate those. So I'm going to turn it over to you and let you look at those storage opportunities for corn.
Yeah, so what I have here, we've been looking at this for the last couple of months. It's just a good place to start as we think about kind of some marketing opportunities, specifically as it relates to kind of the storage side of thing. And so what we have is cash forward contract bids from an elevator here in central Indiana. So that's the gold line. And so that is the bids that they currently have listed on their website for future delivery. And so to kind of put some context to those numbers, I like to try to compare those to basically what is a break-even price on on-farm storage, meaning it's the price today plus we just assess a 1 cent per bushel per month on-farm storage costs. That's going to probably vary from farm to farm, but that just gives us some sort of cost associated with having that grain on farm, and then an opportunity cost, which is the opportunity cost on the money that we could have sold that grain for today. And again, we put a 6% APR on that. It's going to vary from farm to farm depending on what your operating note or whatever debt you'd be paying down with that cash would be. And so when you look at that line, the gray line, you can see that it's steadily increasing by this on-farm storage and cost and opportunity cost. And really what we're doing is we're comparing the gold line relative to the gray line, right? And so the gray line gives us a reference of how much we would need to sell the grain for if we were going to store it to that point. So if we just look, for example, out in April 21, the gray bar gives us a number of 430, which says that if we're going to put the grain in the bin today, we're going to hold on to it until April, we would need to sell it for at least $4.30 a bushel, or we should have just sold it today because we didn't even cover our storage costs and our opportunity costs. And you can see basically throughout the entire marketing year that we're looking ahead towards, the gold line, the forward contract bids are running well below that kind of assumed break-even storage price. And what that's telling us, again, that forward contract bid has two components. It's got the futures component, and then it's got the basis. And so really, we'll look here in a minute at the future spreads, which are not giving us a lot of incentive to store. And then we'll also talk about basis, but the implied future spreads and basis in these forward contract bids is just not really providing producers a lot of incentive to want to enter in one of these contracts.
So you've taken a look at the future spread, and I have to say you've made some small price differences look pretty large on that chart. I'm not sure how you did that, but
yeah. So you got to be really careful with the scale here. And so while we see this kind of positive stair, carry market, when you look at the size of those differences are very, very small. And so I don't want folks to be deceived here by the size of these steps on the chart. So there is positive carry in those futures contracts, meaning that those more deferred contracts are trading for more than the nearby, but it's not by much. Really this chart should be pretty flat. That's really where the market's at. It's not giving us a lot of incentive. So to give you some perspective, that December to July spread, typically this time of year would be more like 25 cents. And here we're looking at 5 cents, right? And so that just gives you some perspective of the narrowness of those spreads in the futures market currently. And again, it's just this incentive that the market is telling us that it really wants us to be bringing that grain to market right now and not storing it for sale later.
All right, so let's take a look at the basis, because the basis patterns, I think, are going to be really important here.
That's right. So, basis is kind of the other major component here that we need to think about as we think about these potential storage returns. And so here we have just kind of a snapshot of the 3-year average corn basis for central Indiana. And again, this comes from the crop basis tool, which is on the Center for Commercial Agriculture's website. I would encourage folks, if you haven't, to go check it out. Pretty simple, intuitive tool that gives you some good ideas of what basis is in your local region, both historically and then for the current year. So looking at this chart, the blue line represents that historical 3-year average. So the last 3 years in central Indiana, that has been the nearby basis pattern. The black line represents this year, this crop marketing year, so September of 2020 onward. And so you can see we're up through that second week of December there, what basis patterns have been in this current marketing year. So you can see that there in central Indiana, the basis pattern has pretty much followed that historical average, which I don't think is too surprising for corn around most of the eastern corn belt that we cover in the crop basis tool. That pattern has been similar to the 3-year average, or in some cases maybe slightly stronger than what we've seen in that 3-year average. But what I think is interesting to think about as we kind of relate this to the story of the supply and demand situation that we just went through is, what are the potential opportunities for basis as we look forward? And so, typically our recommendation is that blue line actually represents a forecast, right? That historical 3-year average is a forecast. And so if you look out, say, into July, the first week of July, the blue line there is right around plus 3 cents, right? And so that would be kind of what our typical forecast, say if we were wanting to implement a hedge or something and we needed a basis forecast into the future, plus 3 cents would be the forecast that we would give. Now, we've done a lot of research looking at kind of these forecasting models for basis. And the one thing that we really know is that as we get further into the marketing year, the ability to forecast basis erodes. And really that happens right there, end of the spring, beginning of the summer. The variability of those forecasts, or the accuracy, I guess I should say, of those forecasts is greatly diminished. And what happens is we know basis can either go one way or the other. And so it becomes really hard to forecast. And what we want to think about is basically, are there years where we can take advantage of that information, right? Because increased risk is not all bad. That means upside potential as well as downside potential. And so what I've tried to do here is compare, that forecast that we have based on this 3-year average, which again, looking out there in July is about 3 cents, with some other years that may compare favorably with what we're looking at in terms of what's going on this year, right? So maybe some tighter supplies. And so the first year I compare it to here was 2019-2020, which was last year. That's probably not a good example of a tight supply year, but it was a tight production year. And so I think it's fair to compare there. And so you can see, throughout the marketing year there, we had pretty strong basis levels relative to what we would see on average going back all the way to harvest. And again, that related to the planning issues that we had in the spring of 19. Now, the other reason this isn't a great comparison is the COVID impact. So you can see there, right about the second week of March, we have basis start to fall off. Again, that had a lot to do with lack of ethanol demand. And so basis patterns didn't really follow a typical pattern. But nonetheless, I think it's only fair to compare it with a year that might be relevant. In this case, last year, that July basis was plus 1 cent. So really not that different than what the 3-year average was at plus 3 cents. So then let's look at the next kind of example I have here. So I went back next to 2012, 2013, which we know was a drought year. So we had tight production. We also had, stock issues that Jim showed you a few slides back on those stocks to use numbers. And so now we look at basis that first week of July and we see this huge pop, right? So $1.20 plus 120 basis for that first week in July. Now, notice that you didn't really get that pop till, way later in the season there. And so this exactly what we're talking about here is, we don't know what basis is going to do as we think about what's going to happen this summer. But what we do know is there's some conditions, some things that are going on in the supply and the demand world that give us some opportunities that there might be an opportunity for some sort of large basis opportunities when we look out into the coming summer.
Stated another way, Nathan, I think, there are years when you think there's at least a chance that you could see a big basis pop in the summer. This appears to be one of those years where that could happen, right?
That's right. It sets up favorably. There's a lot of things that are lined up for that to be possible. That's not a guarantee. We don't know. Like I said, volatility of the accuracy of forecasting basis that time of year is extremely difficult based on the research that we've done. And so here's just one last year to kind of give you, again, a fair comparison of the types of years. So this is 2011, 2012, another year where, we had kind of tight stocks. for corn. And again, you can see that we see not nearly as big, so not plus $1.20, but still plus 37 cents is an extremely favorable basis for Central Indiana relative to historical averages. So again, that would be, it looks like nothing compared to the $1.20 I just showed you, but that would be very, very favorable conditions from a basis standpoint for that point in the year. And so again, what we're really just trying to point out here is that these opportunities are there. We tried to, that's one of the useful things you can do with the basis tool is to go back and look at these individual years that maybe you think are a good comparison for the situation that we're currently in. And that's kind of what we did here, very ad hoc, but nonetheless, it's kind of instructive to think about what the opportunities might be as you think about, some strategies for what you're trying to do on a marketing side of things.
So to kind of sum up there, Nathan, I think thinking about the marketing strategy research you've done, looking back over the last 30 plus years now, you've identified a small number of years, I think 3 or 4 years, where there have been some very positive returns associated with unhedged, unpriced corn storage into that summer, late spring, early summer timeframe. And I think one of your conclusions has been that, you want to think about your marketing from kind of a portfolio standpoint and think about how much of your production do you want to allocate to different marketing strategies. And it seems to me you've just made a case for a year like this being the type of year where having some of your production allocated to that unpriced storage strategy would make some good sense.
Yeah, I would agree with that. I mean, so we've done a lot of research, like you mentioned, on this kind of these different strategies, and that unhedged or on price strategy, put it in the bin and basically wait and see what happens. Like you said, has upside potential for corn, not nearly as frequently as what we see for soybeans, and we can talk about that a little bit later. But there are those years, like you said, where we can see really, really big gross storage returns. Again, we're saying that this could be an opportunity where that could happen. We don't know that, but I think you're right. We've really been pushing the last several years this portfolio idea, and so spreading out risk by having different strategies as a part of the portfolio is certainly advisable. But if you can tolerate the risk, and that's another big thing, right? This is risky, right? There's downside potential here as well. And so if you can tolerate that risk, whether that's from a risk preference standpoint or whether that's from a financial standpoint, there could be, an advantage to having at least a portion of that crop kind of designated to that on-price storage strategy.
And it's a strategy you don't want to fall asleep on. You want to think about it, reevaluate it, I would say once a week or at least once every couple of weeks as we progress through the course of the winter and think about where you're at, what's likely to take place. And that's particularly true as you get into springtime, right? Because we're talking about the possibility of some strong basis plays in the summer months. But as time unfolds, we'll have better information and be able to make a better determination as to whether or not you really want to do that. Because more typically, like for example, when you and I have done some marketing workshops, we talk about probably not storing very much into that summertime frame, late spring and early summertime frame. So it's a risky strategy, one you want to think about. This might be a year when it could pay some dividends, right?
But as you guys have indicated, if you have low liquidity, this is probably not a strategy you want to pursue. And so that's for those that have stronger liquidity, certainly.
I think that's a great point, because I think that putting it in the context of there are opportunities to sell corn and make a profit, right? And if you can do that and you need to do that, that's highly advisable. However, what we're kind of advocating for here, or what we're wanting to point out is that, like Michael said, if you have the liquidity and you're wanting to kind of maybe roll the dice here on some potential big upside, then if you can tolerate that, then there might be an opportunity.
All right, let's turn our attention to soybeans for a bit here. No change in USDA's estimate of the 2020 soybean crop this month. They're still at 4.17 billion bushels. They're still forecasting just a little over a 30% increase in exports for the year, coming in at 2.2 billion bushels, up from 1.68 last year. And a little bit like the corn, I went back and took a look at soybean exports so far this marketing year. So the first 14 weeks of the marketing year to all destinations, those are the blue bars on the chart, as well as exports to China. Those are the red bars on the chart. And as you look at it, so far this year, soybean exports are up just a little bit more than 70%. And the rise in exports to China effectively accounts for all that increase in exports, right? If you look at it from a mathematical standpoint, just kind of adding it up. So that just tells you how important what's going on in China is with respect to their increased demand for livestock feed, especially going into that pork industry. As you look at the carryover estimates, this is a little different picture than what we showed for corn, but there is huge volatility here. In August, USDA was anticipating that we would have a carryover at the end of the 2020 marketing year into the 2021 marketing year of a little over 600 million bushels. That's been coming down every month since then. This month's decline relative to the prior month was the smallest we've seen. It was only 15 million bushels, and that came about not because they changed the supply estimate, but rather because they actually increased slightly the estimate of the quantity that was going to be crushed here in the domestic industry. So that pulls the carryover down to 175 million bushels. Very, very tight supply situation, very tight carryover situation, and radically different than we thought it was going to be back in August and even September. If you look at ending stocks as a percentage of usage, that small change this month actually pulls the ending stocks below, just barely, but still below 4%. A very tight ending stock situation. That's higher than it was in 2013, but not by much, right? And we're going to talk more about 2013 here in a minute. So the USDA did bump up their marketing year average price forecast from 1040 to 1055. That again is the highest marketing year average price forecast since 2013, when prices averaged $13 a bushel. And a little bit like we talked about in corn, as if there's anything else that happens with respect to tightening that supply, that starts to bring those higher prices in play and a higher marketing year average. And obviously what people are looking at, really two things. Again, USDA didn't change the production estimate coming in on this report. I think some people in the trade were expecting to see that come down a little bit. And then the other thing that they didn't do is they didn't bump up the export forecast. And again, I think some people in the trade are looking for a higher export number to show up as we head through the marketing year, particularly looking at the weekly data. And I think it's important to remember that not just US stocks are tightening. World stocks are also being drawn down somewhat. And the percentage changes in the world stocks numbers never look as dramatic as what we see in the domestic industry, but still, a big change when you look at the last several years. On the soybean side, with the dust up with respect to exports and international trade, we saw a big increase with the soybean ending stocks at 33% on a worldwide basis just a couple of years ago, now down to 23%. That's down compared to where it was just a month ago. On the corn side, back in 16, we were at 33%. We've been coming down ever since. And I think sometimes that we lose sight when we look at charts like this in terms of what's really going on there. When you see those ending stocks to use ratios coming down, what that tells you is we're consuming more than we're producing. I think that's important to think about when you start doing that several years in a row, as we've done on both corn and now soybeans as well. So we haven't taken those ending stocks quite to the tight levels we've seen in some prior times. You could see that looking at the chart. But still the trend is there with respect to tightening those ending stocks. So Nathan, you've taken a look at the similar situation or similar information for soybeans that you looked at for corn, but the story winds up being a little different, doesn't it?
Yeah, so I mean, to start out, the story's the same, and that is here we're just looking at these cash forward contract bids, Central Indiana for soybeans. Again, the gold line represents the bids that they have out. The gray line it's kind of that implied kind of break-even price if you're going to store on farm based on our assumptions. Again, the fact that the gold line kind of consistently is below the gray line indicates that those forward contract bids really aren't even enough to offset your storage costs. And so really probably not a favorable strategy to be getting into. Now, the question remains, like we said last time, this assumes kind of futures price spreads and basis. So if we look at the next slide, we have the spreads for soybeans currently in the futures market. Again, don't let the size of these steps here fool you. We're still looking at a pretty flat, structure here in terms of what those soybean futures price spreads are. So we do have some positive carry between January and March, but again, 5 cents is pretty small. And from there, you can see it's pretty flat from there on. And so really the story here that we need to be talking about is the basis side of things. And that's kind of where I want to look at next. And so again, looking at some charts from the basis tool, again, I've just selected Central Indiana for simplicity. And so you can see, again, the blue line here, we're looking at a 2-year historical average. The black line is what's currently happening in the current crop marketing year. And pretty consistently, again, across most of the Eastern Corn Belt, soybean basis has been somewhere between 10 and 30 cents stronger than that 2-year historical average. Again, a lot of that has to do with the supply and demand situation that we just kind of walked through. And again, I think what's useful is to kind of do a similar exercise in terms of thinking about, what kind of basis opportunities, what might we be thinking about as we look kind of into the later in the crop marketing year and the kind of late spring, early summer time frame. And so again, just picking the first week of July as a kind of comparison for all the charts I want to look at, the 2-year average in Central Indiana is a negative 17 cent basis. And so then again, what I did was kind of go through and look at some years that might be comparable from stocks point of view, right? So we just showed the chart that stocks have come down notably over the last several months, bring us to, I think Jim said was 3.9% on that stocks to use ratio. And so I went back to the time frame when the last time we saw those sorts of stocks to use. And so starting in 14-15, and we'll work our way backwards in history here, that first week of July basis was +5. And so again, you can see that there's kind of some slight appreciation in the 14-15 crop year. Notice beyond the time frame that I've identified here as July, first week of July, the first week of August, we were looking at a basis of +75, right? And so again, it's this idea that if we're in a year where stocks are tight, at some point during that crop marketing year, particularly later in the marketing year, the summer months, when somebody needs grain, there are going to be opportunities to price grain at favorable levels with very favorable basis, incentivizing folks to get that grain to market.
Yeah, and so I think that's a key point. And one of the things I was thinking about when you were talking there, Nathan, is the fact that when you're sitting there on the 1st of July, you probably didn't really have a real strong idea that we were going to see that pop show up 4 weeks later, right? That's the challenge with trying to capture these returns. They're hard to forecast, right? That's one of the elements of risk that we talk about. It's difficult to anticipate what's going to happen, but we do know you get towards the end of that marketing year and supplies are very tight. Some buyers, not all buyers, but some buyers are going to have to pay up, right? And if you're in a location where you can take advantage of that, there's some opportunities.
That's right. And so here's another chart. Again, this is just going back one additional year, so to the 13-14 crop year, still looking at Central Indiana. And you can see that basis there in the first week of July, +71. And so just to kind of, and again, if you look out there the first week of August, we're looking at, what is that, probably $1.50 or so. And so to your point, we don't know, when it's going to happen, very unpredictable from a forecasting standpoint. And the other thing that you kind of alluded to that I think is important as well is, we don't know where it's going to happen, right? And it depends on kind of what the local market looks like. And so, we were talking about this particular chart earlier this afternoon, And if you look down in the southern part of Indiana during this marketing year, I think that that first week of August basis got up to $1.80, almost $2, right? And again, that was just a local issue where closer to the river, there probably was a need for some grain, and there were some opportunities, crazy opportunities from a basis point of view in making some marketing decisions.
One more.
So this is the last one. So again, just one more additional year back, 12, 13. Again, we were still in a tight supply-ish world. And again, you can see, there was some kind of steady basis appreciation at the beginning of the year. Looks similar to what we have at the beginning of this year. That kind of, bounced around a little bit, but, getting out into that first week of July, we were at plus $1.12. And so, pretty big swings here when you talk about $1.12 over futures, especially during this time frame when we had favorable futures prices. And so there are some really, favorable, some really high flat price opportunities for people. And again, going back to what we said for corn, all the same caveats apply as it relates to, these things are really hard to forecast. This is an opportunity that has risk associated with it, meaning that there is upside, but there is also downside. And so, how you kind of evaluate this, it depends on the individual operation and your ability to kind of tolerate that risk. I would say, and Jim, I'll throw this back at you. I think from the standpoint of corn versus soybeans, I'm much more confident in the idea of there being some of these potential for basis pops later in the year on soybeans this year than for corn. But again, we're going to learn a lot here over the next couple of months, and that, corn, the situation with corn could change as well.
Well, I agree. So the first thing I think about, Nathan, is the research that you've done over the last 30 plus years, looking at returns, and the unpriced storage returns have a higher probability of generating a very positive return for soybeans than they do for corn. So that's the first thing I think about. The second thing I think about is, what would cause this to happen? And the scenarios are different for corn versus soybeans. First of all, the soybean situation, supply situation relative to usage is much tighter than it is for corn. So that increases the likelihood. The second thing that's different is the soybean situation is keyed off of really two possibilities. One is that maybe the yield numbers come down from the 2020 crop, which would tighten things further. The other thing is what's taken place with respect to exports. And if the export demand is as strong as some folks think it might be, and I think there are some people in the industry that think USDA's forecast continues to be too low. I think on this report, on the WASDE report, on a worldwide basis, USDA did bump up imports of soybeans into I take that back. They bumped up their forecast on corn, but they held their soybean imports for China constant. But some people think that could increase even more as they continue to rebuild their livestock sector. Keyed more heavily off the export side. The driver in the past, at least in the recent past, for a basis play in corn has been very inelastic demand coming out of the ethanol industry. And for that to happen in 2021, we're going to have to see a pretty dramatic improvement in the U.S. economy. Now, by next summer, that could happen. But sitting here in December, it's hard to get real optimistic about that, given what's probably going to happen over the next 2 or 3 months. So that's the risk as you think about it. But certainly looking at history, your analysis really suggests pretty strongly that it would favor soybeans over corn, right?
For sure.
All right. So let's turn our attention to some, not only returns for 2020, but actually also some returns for 2021. And Michael, you've taken a look at some things with respect to the case farm that you've established here in West Central Indiana.
A couple of things I want to point out is kind of tied back to some of the things that both Jim and Nathan were talking about. And certainly the prices that Nathan was talking about in terms of those forward prices are very strong compared to break evens. There's a lot of people out there that have break evens for corn 4 or under and break evens for soybeans of 10 and under. And so certainly it's not surprising to see in this chart that 2020 estimated crural net farm income is the highest it's been since 2013. And the reason why it's a little higher than 2013 is the government payments were relatively strong in 2020. And so the crop income in 2013 was higher. We talked about those prices. It was about $4.50 for corn and $13 for soybeans, something like that. So higher than what we're facing right now. But the combination of relatively strong prices and a very good government payment for 2020 reflects a very strong net farm income for 2020. The prospects for 2021 are still really uncertain. It really depends on what corn and soybean prices are going to be for the 2021 crop. And of course, that's based on acreage and a lot of other factors that have to play out. But if you look at the futures prices right now, the corn futures prices are lower, for December compared to July, and the soybean futures price for December 21 is considerably lower than July 21. And so part of what's going on in my 2021 bar there is expected lower prices for the 21 crop, at least where we sit today. But a big chunk of that's the drop in government payments. We were going from about $65, $70 per acre in 2020 to my forecast of no government payments in 2021. At least that's my initial forecast here. And so that's why 2021 does not look quite as good. The combination of lower government payments and perhaps lower prices for that 21 crop.
Michael, I think you mentioned this, but I think it'd be good if you maybe elaborated on a little bit. These estimates are all based on accrual accounting. So tell us a little bit what you mean by that relative to cash accounting.
Yeah, the 2020 bar would look a lot better if you're looking at cash because obviously the prices this fall would translate into some pretty good cash incomes, particularly if you sold quite a bit of your crop in 2020. But a big portion of the 2020 accrual net farm income is the 19 crop that was stored into 2020 and then subsequently sold. And so it's very important to keep that in mind that just a portion of that crop income is related to the 20 crop. The other portion is due to the 19 crop where the prices were not quite as strong as what they are have been this winter.
All right, so you've looked at some other aspects of the financial side, so let's talk about that.
Yeah, I typically don't talk about this, but I think given all we've said about 2020, I think it's useful to talk about this. 2020 is really an opportunity, to certainly cover term debt. That shouldn't be a problem for most farms to be able to cover term debt unless they didn't get the net farm, the high net farm income that we're talking about here. And there is some farms for whatever reason where 2020 was not that great a year. But for most of the farms, the strong capital debt repayment margin, which is the amount of money we have left over, it signals that it's a chance to improve liquidity. Liquidity has been drawn down substantially since 2013, so it's a chance to improve liquidity through increasing current assets, but it's also a chance to perhaps replace some of that machinery and equipment that's been very difficult to replace since 2014 with the lower net farm incomes. And so that's why I wanted to show this chart, is that a very strong cash flow translates into improvement in liquidity and perhaps an ability to replace machinery and equipment.
Yeah, good point.
Okay, let's go back to the chart that we typically show in the monthly webinar. And this hasn't changed all that much from last month, and it's changed a little bit from October, but not too much from last month. And it just shows the same story we've been talking about here today. Is we have a pretty strong net return to land in 2020, close to $300, the largest we've seen since 2013. We're sounding like a broken record there, but it's true in terms of net return to land also, and it's higher than cash rent in 2020. And so that leads me to believe there's going to be upward pressure in 2021 cash rental rates. What happens to 2022 and beyond that really depends on where net return to land ends up being down the road. But I think looking at some other information, I think we're really reaching an equilibrium between cash rent and net return to land. And what I mean by that is the downward pressure we've seen since 2014 on cash rental rates appears to have disappeared. And so we're more in a situation where cash rent's going to adjust to the to the forecast of where net return to land ends up. And if that net return to land in 2021 is 200 to somewhere in that 200 to 250, there's really no pressure to decrease the cash rent in 2022. And so certainly upward pressure in 2021. And I think we're going to see some stability past that also. And depending where prices end up, we might even see some upward pressure for the next several years.
And that perspective has changed very rapidly. You know, we asked that question on the Ag Economy Barometer survey in September and October. And the change in responses we got from September to October was pretty dramatic. We had very few people said they expected to see higher cash rental rates in September for the 2021 crop year. In October, that jumped up all the way to almost 40% said they expected to see higher cash rental rates. And we've got that on this month's survey. We'll know those results in early January, but things changed rapidly as the prices changed. And
the marketing year average prices, we talked about that earlier, for corn increased dramatically from the summer to the current estimate of $4 corn. And the same for soybeans. Soybeans was even more dramatic. We're at $10.55 right now for the U.S. Marketing year price for the 20 crop. That could change even higher depending on where prices go. But that's certainly much higher than what we saw earlier this summer. And so the combination of higher prices and perhaps higher payments for CARES Act coming out of the CARES Act really really increase that net return to land.
Yeah. So you've taken a look at some longer term issues with respect to land values as well.
Yeah, this is where I'm saying that I think we've approached an equilibrium here. And let me explain this chart a little bit because it is a little complicated. The 10-year average cash rent, which in this case is land price divided by the 10-year average cash rent, that's the blue bar. And then the red bar is the land price divided by the 10-year average net return to land. And you can see that blue line was considerably above the red line from about 2012 all the way into 2016, 2017, 2018. That was telling me that there was a lot of downward pressure on cash rent. Cash rent was relatively high compared to net return to land. Right now, that's not the case. And in fact, they're very similar right now. And so that downward pressure on cash rent that we've seen since 2014 appears to be over, with the caveat if something would happen and we return to low prices in late 21 and 2022, then we could see another round of downward pressure on cash rent. But we're in a much different situation today compared to what we've been since from 2014 to 2019.
And of course, if there's upward pressure on cash rental rates, Michael, what does that spell for land values?
Well, if you assume that the interest rates is going to stay about the same, which would be my best forecast, that we're not going to see a large increase in interest rates anytime soon, that would mean that if cash rent goes up 5%, we would see a similar increase in land values.
And it's going to be interesting to see. We're going to talk about that topic at length at the Top Farmer Conference. So that'll be a good topic for down the road, but certainly it suggests some upward pressure.
Now, the latest data from Iowa, I checked that here this afternoon, was a September survey. And, the September survey was just at the start, and you don't know exactly when they did the survey, that it was reported in September 2020. The Iowa land values were flat. There's another survey coming out here in December. I would not be surprised to see that on that survey that we actually see an increase in land values in Iowa to kind of start this trend in increasing land values rather than decreasing land values.
That would be
one more slide related to corn and soybeans in particular. We've had a very good run on soybeans. This is for West Central Indiana. It's true across most of Indiana where soybeans have been more profitable than corn. That's what the red bars mean. In 2019, we had good yields and strong government payments related to corn. We actually saw higher profits for corn. But in 2020, again, we're seeing a very strong profitability for soybeans compared to corn. And soybeans this year, corn was close, but soybeans this year actually earned economic profit. I haven't uttered those words in a long time, but soybeans actually earned economic profit in 2020, meaning that you could cover your cash costs and all opportunity costs on soybeans. And so that's why soybeans looks relatively good here compared to even corn in 2020. 2021 has been moving around depending on when I look at this, from a slight advantage to corn to a slight advantage for soybeans. We're actually seeing a little bit more advantage for soybeans recently with the recent increase in soybeans. Right now, we're at about $40 advantage towards soybeans. And so this leads me to believe that we'll have about a 50-50 split in corn and soybeans for 2021. And so that's my initial forecast for what the prospective plantings for corn and soybeans in Indiana, a 50-50 split.
And if you think about it more broadly than that, Michael, a lot of discussion in the trade about the possibility of seeing a pretty large increase in U.S. soybean acreage, and your chart would support that idea. And that's probably what it's going to take to pull the soybean acreage up. And given the tightness of the carryover situation, that's what the market's going to be looking at. But
yeah, and if that stocks to use gets even tighter, we'll have more than 50% soybeans in Indiana. So that's going to be something to really pay attention to, is where the stocks to use for corn and soybeans end up here the next 2-3 months.
All right. So with that, I'm just going to mention to folks again that the possibility of registering for the Top Farmer Conference is out there. Details at our website, purdue.edu/commercial-ag. And if you do register, you'll get a notice in the short run here that says we're full, but we're in the process of increasing the capacity for the conference. So you'll get a subsequent email later on when we get that resolved. So with that, I'm going to say thanks for joining us. On behalf of my colleagues, Nathan and Michael, appreciate the opportunity to visit with you about the outlook. And on behalf of the Center for Commercial Agriculture, I want to wish everyone Merry Christmas and a Happy New Year. Thanks for joining us.